There's a lot of wonderful things about self-directed IRAs, but there's also some laws. And unfortunately, as we know, bureaucracy in the government works is the longer a government program runs, the more it becomes the closest thing to immortal life in the universe. And so what started in 1975 as a single small document on traditional IRAs and the ability to put money away for retirement is now grown to well over 66,000 pages just for IRAs between the Department of Labor and the Congress and the Treasury Department. The trust is held on IRAs through the Treasury Department, and the rules are administered by the Department of Labor. So it lends for where you might go to one thing in the Department of Labor to look up if you can do something. It has the incredible effect of saying, well, yeah, maybe you can do this, but you need to go to Treasury Department document, whatever, and then you get Treasury Department, they say, well, to actually find out where you can do this, you need to go to DOL document 512 or 513 subsection, whatever. So this is the dilemma that people are forced with. And it can become very confusing. And a lot of CPAs who don't study the law and study self-directed IRA law, they have a tendency to fear it. And they will say things like, oh, I wouldn't do that because, doing that might be illegal and this, that, and the other. Well, self-directing your IRA, all IRAs are self-directed just by the nature of the trust. All IRAs are self-directed. The difference being that IRAs that are at firms, large wirehouse firms where you're trading stocks, those IRAs, you're trading the stocks, or you have a financial advisor who's trading the stocks, but they can't trade without your approval, thus making it self-directed. What we do is, instead of doing any trading for you or buying and selling, we allow you to have 100% of the control on what you buy, when you sell, what you do, how you do it. If it's a piece of individual real estate, if it's a loan that you've given or taken, if it's any number of things, if it's buying cows and getting capital gains and dividends and all the fun things that we see that people do with their IRAs. But there is a section of the law that has to do with what defines who an IRA owner is and is not, and what they cannot do. The IRS and the Department of Treasury, who the IRS falls under, and the Department of Labor, they're kind of like a bad parent. They don't tell you what you can do, they tell you what you can't do. So it's kind of a negative of whatever and if it's not in there, then the assumption is you can do it. So, and it's been that way since 1975. So people will say to us, oh, is this something new? No, people have been doing this since 1975. And there has been plenty of case law backing up what people have done, and that it is legal, and you just have to follow the rules and not do what's called a prohibited transaction. So when you think of your IRA, think of your IRA as Uncle IRA. It's like an individual. And Uncle IRA has certain rules and laws that it has to follow. And there's certain people that Uncle IRA can't do business with, cannot do business with. And these are called disqualified persons. And let's go through those lists of disqualified persons. You are the fiduciary of your plan, which means you're responsible for the funds in your plan. So you are the fiduciary. You cannot do business with your IRA as the plan fiduciary and as the owner of the funds. Other people restriction is if you own a company, you and your company or your company cannot do business with an IRA. Also, linear ascendants and descendants. So parents, grandparents, and their spouses, you cannot do business with them. They cannot do business in your IRA. For example, if you buy a piece of property, you can't sell that property to a grandparent or a parent. And vice versa, if they own a property, they can't sell it to your IRA. Now, that doesn't mean that they can't partner together. So, for example, if you and your parent want to buy a piece of property together, say a rental house, and go 50-50, as long as the entire sale is made on the same day in the same set of documentation, that's legal because there's no buying and selling in between. There's no prohibited transaction between disqualified persons. And the way that you have prohibited transactions is the only way is through disqualified persons. So that's why we go through this list of who the disqualified persons are. So, and parents, grandparents, and the spouses thereof are all ineligible or disqualified persons from doing business with your IRA. Also, your children and your children's spouses are disqualified persons. So they cannot do business. You can't buy and sell between kids or between kids' spouses. And that goes down to grandchildren and their spouses. None of these linear family members can do business with Uncle Ira, your IRA. There's also direct and indirect people that could be considered disqualified persons. And although brothers, sisters, aunts, uncles are not disqualified, if you're dealing with those members and they receive, not only does your IRA receive a benefit, but they receive a benefit. For example, if you had an indirect disqualified person like brother, sister, aunt, and uncle, if you had a relationship with, let's say, a brother, and that brother was earning a commission off of your IRA, or your IRA had an opportunity to make money back because of something they earned, that could be a disqualified person in indirect rule. So there are certain rules that apply to non-linear relatives. Most cases, if you're just buying and selling in between, things like that, that's okay. But just be aware of the rules and go to a qualified person that deals, CPA or attorney, tax attorney that deals inside of self-directed IRAs and understands what the rules are. They're very hard to read and there's a lot of them. And we're more than happy to give you the rule numbers, but there is still, you should seek out a qualified person to help you with that.